Welcome to episode 3 of Compounding Brothers. What's up, my brother? Good to see you.
Hi, Joaquin. It's a pleasure to see you again. And I'm excited for today's episode.
You're looking good. Looking good there. Sunny days.
Yes, this was barbecue with friends. As you know, Marisa and I have kind of got empty nest nowadays. So we're spending a lot more time with friends and with our four-legged children. You can see below.
Very cute. Different stages in life. You need to enjoy each of them as they come. So, Claudia and I celebrated our anniversary, 21st anniversary. And there we are, the two of us, and then with a full offspring, having a great time this past week. And this is proof that love is serious business, my friend.
Indeed it is.
Very good. So what a week we just went through, and how interesting are the times that we're living.
Yes, may you live an interesting time, they said.
I thought I wanted to bring this piece of news about contemporary Amperex shutting down. Allegedly, is a license that wasn't renewed, shutting down this big mine that accounts for 6% of global production in Xiangxiahuao. And this is a mine that not only represents 6% of global production, but also is a key element of the integrated supply chain that they used to run. But also it's a mine that is incredibly cost inefficient. So it's a mine that is producing a ton of LCE at $14,000 per metric ton. The numbers we discussed last week for Sociedad Química Minera de Chile and for Albemarle, and we're talking about a mine that is operating 2, 3, 4x the cost of the brine in South America.
Yeah, I think what this brings home is our investment thesis, which was to go for the lowest cost producer in an industry that we believe is underappreciated. As we can see, we've seen the shutdown of a mine that's sort of in the upper end of the cost curve, and that has benefited quite a bit our two picks, because lithium price will go up as you start seeing these participants leave the industry, and that has benefited obviously our two picks, and more so because of the operating leverage the increased price represents.
Our prior episode was incredibly timely because in the 5 days since we dropped, the price the price of Albemarle went up, close to 20%, and the price of SQM went up 26%. And call me a skeptic, but I don't buy that this is just a license. I think the Chinese were losing a ton of money on this mine, and they used this anti-involution government policy to justify the closure of a mine that employs a ton of people and is very relevant to the province in which it's operating. And it's what you just said. It's an opportunity for the low-cost producers, because given the sort of glut that we're seeing today, the high-end cost producers at the upper right hand of the cost curve are just going to be destroyed. And who's going to benefit from this? The efficient producers, such as the ones we discussed. The other piece of news that I found interesting is that everything is converging to have a boom in the solar plus battery endgame for energy. And this Bloomberg article caught my attention because it's saying that mega batteries are the set to power Europe's next big energy. See, what's going on is because they invested so much money in renewable energy that only works when the sun is out or the wind is blowing. They have this 5, 7, 10% of the time negative prices of energy that are going to be wasted and dissipated because it has no use. And the only way to capture, to time arbitrage that, is to invest in batteries. So imagine what this is going to do to the demand of batteries and lithium.
Well, that's a great point, and very very timely also to what I'm doing now, which is um, uh, I work as chief strategy officer for a multinational flexible packaging producer with probably about over 1 million tons of production capacity in the Americas and Europe. And we have to look at an alternative, cheaper sources of supply, because as you well know, in strategy in commoditized business, it is efficiency, efficiency, efficiency. So that's how you get a leg up on your competition. And we have been exploring solar, and some of the challenges that remained for us were in the battery space. But as battery technology is improving and becoming cheaper, it's a blessing for us.
Absolutely. And more renewable energy is going to continue coming, as we discussed. Just the right law for panel production is at like 45%. So these prices are going to continue decreasing. The battery prices, as we can see in this excerpt from the article, the battery prices are plunging. So the combination of solar and batteries are just going to become more and more efficient. So this is a continuation of the hockey stick demand for solar and for lithium as the end game for the energy transition.
Yeah, and it's a wonderful it's a wonderful thing for sustainability of people like me and enterprises like the one I'm involved with.
Absolutely. So this is, I thought, interesting that we had this price markup that we were just talking about. This is just other model. You could do the same chart for SQM or LAR or any one of those low cost lithium producers. And the price increase that we saw from like 60 to 80, 55 to 30% since the bottom, compared to the history of this opportunity, is just a blip. A blip is a drop in the ocean.
That's right.
So back to the root cause, the fundamental driver of what's behind all this is the technium and the unstoppable growth in demand for semiconductors. And I thought very interesting this war of words, if you will. I mean, well, essentially was on one-sided, because the approach that Trump takes is he first carpet bombs you and then he sends you flowers, chocolates. But then when Liputan came out with an internal memo, which was clearly intended for a broader audience, said that they were going to stop investment in the next manufacturing technology for semiconductors, both you and I knew that was going to be short lived. And immediately came the reaction from Trump saying, you cannot do that and you need to resign. Lipu jumped into his G700, landed in the White House, and then it was all love and kisses. And essentially, we're now hearing that the government may take an equity stake. Clearly, the fear that you and I had was that when Libu came out and said we need 40 billion, actually it was Craig Barrett, the legend, former Intel CEO, said there is a way out. The way out is 40 billion in capex. Lip Bhutan saying we cannot fund that. We don't have the wherewithal. And then the administration saying, no, don't worry, we're going to help you. I think this is clearly a sign of the times and how critical chips are. Chips are going to continue being the bottleneck, and Intel necessarily is the only one that can position itself at the chips national champion.
Yeah, and we've been discussing this since episode 1, and boy, am I glad I actually doubled my position before Trump came out uh, with with that little beauty of a comment this week.
So now we're partners with the White House. I think valuation wise, again, this is opinion and advice. Intel was very cheap, even despite the fact that it couldn't fund the 40 billion fab capacity that it required. But what's going to happen next, and this is our prediction, is that the same way Trump was the salesperson for Boeing, Trump now is going to be the champion salesman for Intel. And Intel only needs the first customer. It only needs one customer. And for sure, I think people are, now that the White House is an owner of Intel, are going to make a line in the Rose Garden just to say, we want to be the first customer, which is going to make Intel viable.
That's right. And you get a company that has a tangible book value of $20 per share. It's sitting at 25 right now. So still very, very cheap considering the potential you and I see in it.
Yeah. Now, the profit pools that we're dealing with here are gigantic. If you think that NVIDIA is selling like third-class chips like the H20s to China, and they agree for the White House to take a 20% cut and still make money, it's really unfathomable in terms of the size of the opportunity. You can sell third-rate chips that are pretty much obsolete for a US-based consumer, sell it to China, take a 20% cut to the government, and still mint money. I think this is really an indication of how insane the demand for this industry is in the short term and the medium term and the long term.
Yeah, and let's face it, we need to de-risk Taiwan. That is one
we need
of
to de-risk
the
Taiwan. We need to bring capacity to the U.S. and we need to make sure that we need to make sure that China remains, 3, 4, 5 years behind in terms of their ability to use artificial intelligence.
That's right. So this is definitely a move in the right direction in the geopolitical sense.
So in terms of the Technium unstoppable march, I thought this charge was striking. Just the notion that in the short term we're going to be spending more money building data centers than general office space really blew my mind.
Yeah, and I don't know if you saw the announcement in the last Meta call when they mentioned the Prometheus data center. Supposedly, it's going to be the size of half Manhattan. So these are awesome numbers.
Which goes back to maybe Bill Gates is an investment genius. I mean, he's been accumulating farmland for the good part of the last 20 years. And clearly, I think land is going to become scarce. You and I know that Trump tried to pass, this sale of federal land in the One Big Beautiful Bill that was eventually shelved. But I think to your point earlier, we're going to need a lot of lands because we need to build a lot of data centers. We need a lot of solar farms, and we're going to be building a lot of housing as well.
Yeah, and Bill Gates, apparently, I read somewhere this morning that he's accumulated about 700 million worth of land in the U.S. So that's quite a bit.
Yeah. And this piece of news, I think, is going to become the norm. And there's going to be a political backlash because unless data centers start building their own power, we're going to see more of the events that transpired that in PJM, in the PJM interconnection grid, where prices skyrocketed and is creating a lot of issues for regular Americans that are seeing their utility bills go through the roof. And more, the only way to satisfy this own power need is through gas turbines and natural gas.
Yeah, it's what we discussed in episode one. We have a transition fuel, which is nat gas. And then in episode two, we discuss what the end game is, which is solar, with the good batteries and microgrids. So in the interim, we're going to have these problems continue, and nat gas is going to be higher and higher.
Indeed. It's interesting that we're already starting to see AI displace humans. We're seeing this type of news already filtering through the major newspapers. On the left, a piece from Bloomberg that questions whether AI is killing entry-level jobs and stressing that job postings have plunged and unemployment is rising for young people, right? So entry-level positions, which are probably easier to replace via AI repetitive tasks, that's potentially a problem because entry-level jobs is when people get the job training. And then on the right-hand side, this piece from the Wall Street Journal that many creative careers are being threatened. And then those individuals, writers, actors, musicians, are becoming counselors and are seeking degrees
Yeah.
in psychology.
Yeah, that was interesting. That was an interesting read.
And that's not only in the news. The hard data is already showing. This is a chart showing unemployment rate for the 20 to 24-year-old graduates, and is spiking. So it's not only something that is in the sentiment, but it's also in the hard data.
Yeah, and it's no coincidence that you see the start of the spike in the AI era, which is from 23, early 24 onwards. And it's also been a time when unemployment really hasn't budged much. So we're seeing sort of a cohort of the American population sort of affected by AI, and that is probably the young people you mentioned.
Yeah, and outside the time frame of the pandemia, and outside major financial crises such as the GFC, the Great Financial Crisis in 08, 09, the spike in the unemployment for the youth is the highest that we've seen in a long time. And if you look at the spike after the GFC, it was a very slow grind down of the unemployment rate for 20 to 24-year-old graduates. And now we're seeing an inversion of the trend. This is something that is also going to cause a lot of heartburn. In terms of jumping on to back to energy, because the technium is marching on, the technium is building data centers, is consuming energy. Thought very paradoxical to read that the IEA is forecasting a record supply glut next year. At the same time that in Zero Hedge, we're reading that we're seeing price spikes and blackouts in the power grid. How do we reconcile these two?
Well, I think you reconcile it by the difference between drilling for oil and drilling for natural gas. And by the way, I'm talking about the context of shale horizontal drilling, right? I think you may get a lot of shutdowns of these drilling capacity in oil, but you're gonna get an increase in the demand for nat gas, and this is one of the reasons why you and I decided on nat gas as being the preferable fuel and the better investment to drive not only AI but general electricity consumption.
Right. And the argument that someone might make against natural gas is look at what's going on with energy prices. And your point is very important because not all energy prices are created the same. Energy prices have different segments and different segments in different geographies within the universe of the energy spectrum. So when we're seeing that the oil price might go down and it's going down, well, what you're saying is that the break even for many of fracking um, the fracking universe is where it's $55-$60 a
Yeah,
barrel, right? So
thereabouts.
when that price goes down, that makes many of those rigs economically unprofitable, and therefore what happens is that we reduce the produce of oil, but also of the ancillary natural gas that comes with that production, right? So the reduction in the oil price is going to come with a reduction in fracking rigs and the reduction of the production of oil and gas. In contrast, for the pure natural gas producers, as you rightly pointed out, the situation is completely different because it can be that demand is going up, the price of natural gas is going up, at the same time, the price of oil remains low, which is more demand and less supply from competitive sources of natural gas. So the whole thing creates sort of a virtuous confluence of factors that may benefit players such as, again, this opinion and advice, such as the players that you and I liked and we mentioned 2 episodes ago, Range Resources or EQT,
And EQT.
correct? Am I interpreting your perspective right?
That is absolutely correct. We like pure play nat gas in the low end of the cash cost curve. That's it. That's the best way to put it. And what we're seeing with lower oil prices is the fracking of crude oil and nat gas along with it suffer.
That's
But
exactly right.
it's going to help our plays, our picks, because that nat gas that comes off the market is going to increase eventually the price of nat gas, and not necessarily oil, nat gas, and we'll be the better for it with our plays.
That's right. I found this Bloomberg piece hysterical. If we think that France is the cleanest dirty shirt in the European energy landscape, clearly they're better off than the Brits, they're better off than the Germans that turn off all the nuclear generation after the tsunami in Japan. And to think that the French are shutting down nuclear reactors because they have jellyfish clogged in their pipes, it's truly incredible. Imagine what this is going to do in terms of demand, not only for renewable energy, as we mentioned before, for batteries, but also in the short term for natural gas. And there are very nice natural gas producers in Europe as well.
Oh yeah, I can only see LNG. If this continues, LNG prices are just going to go sky high for European delivery. But
24, 36 months are going to be very critical for natural gas, and there's going to be shortages, and prices are going to skyrocket. All the capacity for LNG exports is coming online. All these data centers, as you mentioned, Meta and all the hyperscalers are coming online. We saw the piece of news. To each its own power generation, otherwise licenses are not going to be granted. They will not be able to connect to the grid. And Europe is going to be thirsty for natural gas. So the confluence is just almost like a perfect storm.
It also makes you wonder where Bitcoin miners are going to get their energy.
Yeah. Well, the beauty to some extent of mining Bitcoin versus generating tokens is that you can pick the time of the day. So
Yeah, that's true.
the miners can actually be sort of the marginal buyer at the time when there is excess supply and little demand, and they can turn on and off, and that can be a good sort of offsetting factor. But to your point, on average, the cost is going to go up because the baseload capacity needs to go up as well.
And until battery technology gets good enough where the cost is basically the same during the entire day.
That's exactly right. What do you say of these charts? There's only 2 times in history where the ratio
Hmm.
of oil to the S&P 500 has been lower: 1999 and 2020.
Well, having spent uh, nearly 30 years in metals and mining and trading thereof, um, I tell you, it's impressive. It shows you how cheap commodities are, and it also shows you that with oil being as cheap as it is, um, oil has always been a proxy for gold miner operation costs. So it tells you quite a bit about where operating costs for gold mines are and where they will be for probably a bit of the future, given the glut that the EIA says is coming in oil. So it is a wonderful time to own gold stocks because I just don't see any pressure from in operating costs from oil. Which is for the diesel that the trucks use. And I also don't see a lot of, given iron ore prices, I don't see a lot of pressure on steel. So
That's right. And
very interesting.
as we're going to see later in our conversation, this is not the only reason to own gold.
Yeah, and this also makes me very bullish on things like copper miners because the and even rare earth miners. Um, the operating costs are low. These commodities are starting to sell for great prices, and it's only the beginning. I was just going to mention that we're in a very interesting time where millennials and young people have been priced out of the market. So going back to the upper right corner of your presentation, yield curve control is going to be what solves a lot of the affordability issues for young people.
And the political pressure and the economic need to reduce rates is inevitable. It's completely a fait accompli. And the more that Jay Powell resists that impulse, the more this is going to continue becoming a house of pain for him. We already saw 2 dissents in the last FOMC meeting, which hadn't happened in decades. We are seeing the nominees for board, Miran and Bullard, saying that the tariffs are not causing inflation. We're going to be discussing that. And in a PR stunt, the Treasury Secretary mentioned that there are 11 candidates that are going to be singing the praises of rate reductions for the next few months. This is going to become a very uncomfortable, lame duck tenure for Jay Powell.
Yeah, he's got 9 months left, so it's going to be it's going to be very painful.
Yeah, but it's going to be 9 months of delivery pain, not 9 months of pregnancy for Jay Powell.
Yes, yeah, correct.
And they are hitting him from all. Look at Jay Powell's face in that picture with Trump when Trump visited the Federal Reserve. He's enjoying that visit like no one. And he's being hit by all the smart operators in the market, including Rick Reader. He's being hit with lawsuits, and he's still resisting, in contradiction to his own words. He himself has said that the tariff are a look through, and then the argument he uses not to move from a very restrictive rate stance is tariff uncertainty. When the evidence is becoming overwhelming, and we have precedent in the first administration, in the first Trump administration, that the tariffs were never inflationary, right? So in the meantime, as you mentioned before, and that piece from Bloomberg in the bottom right stresses, Americans are priced out of home ownership. So people have their lives in suspense simply because someone is too proud, focus more on his legacy than what the economy needs right now.
If he was focused on his legacy, he'd actually be cutting rates. I think it's political legacy he seems to be worried about.
This is inexplicable, completely inexplicable, and the fact that there are so many other voting governors still talking about being unconvinced regarding the need to reduce rates, it smells really more of a political job than true economic policy making. That's my take.
I agree with it.
And in the end, what we need is to enable the excess of debt that we have in the government to transition into the private sector. And this chart shows how much home equity is trapped because of the high rates. So the household mortgage loan to value ratio is the lowest since the 50s. And the reason for this is many people who cannot exit their homes, many people who cannot refinance into new mortgages, many people who cannot get their first homes. And all of this is going to be unlocked whenever the rates come down. And the rates need to come down probably 150 bips at the least. And if you add another 50 or 75 bips that you can compress the difference between the mortgage rates and the 10-year bonds, we are creating the setup for a massive boom in housing.
Yeah, I agree. And this chart seems to me to have an underlying bifurcation where boomers have been either completing the payment of the mortgages they had on their real estate assets, and you also have young people which don't have access to home ownership. So that's why I think you have something as low as this, but I think this is an average number. And if you start looking at the extremes, you start seeing some pretty interesting things. We know that boomers could take out home equity lines of credit or take out a new mortgage on their homes in order to get money to live comfortably through their golden years. And at the same time, young people could access the mortgage market to buy properties. But what do we need for both of those? Lower rates.
Yeah, and lower rates, I think, are part of the inflation problem, because as we're going to be discussing in a second, when you have the level of debt in relation to the GDP that we have, high rates become stimulatory for the economy. So there is a good case to be made, and when rates come down, actually that's also going to help them in their inflation. Most companies are insensitive in the short term to interest rates. Many companies termed out. Consumers have a very low leverage ratio. So the only thing that high rates are doing is making the fiscal deficit larger. And I think the fact that they are so stubborn is suspicious. And I think it's a big problem that they are persisting every month that goes by. Um, every time, 100 bips cost us 300 billion. So every time they go by, every month that they go by, you can do the math in terms of, it's costing us, 24 billion per month just to keep rates too tight. And that's unacceptable. And while in the US we have this dearth of housing supply, China is going through the opposite situation. And this is lingering and this is indigestion for the entire Chinese economy, who has been driven through, essentially hard investments and investment in fixed assets, largely constructions and roads and infrastructure.
Michael Pettis, for the last 10 years or so, has been talking about reorganizing the Chinese economy towards a demand driven economy. Consumer demand is sorely needed. His response was to put in social programs like medical programs and certain retirement programs, so that the Chinese don't save as much as they do and consume more. I think he's very right about that. A lot of the property investment was a savings vehicle by the Chinese.
Exactly
So
right.
if we had incentives to consume by having things like medical care and things like that accessible via a social safety net provided by the government, we could turn the economy around. But notwithstanding, I think there are some extraordinary values in China, in the Chinese stock market. Both you and I really like Alibaba and Pinduoduo, otherwise known as PDD. These companies have net cash, and they just keep growing the cash pile larger and larger on a quarterly basis. And they are trading very inexpensively. And we've owned them for over a year now. So I think China is very interesting, and we're going to have to see what the government does. But certainly it's a universe of investing where you see a lot of cheap value.
Yeah. That point that you're making in terms of lack of social safety nets, lack of retirement insurance, lack of national reliable healthcare insurance, childcare, that forces the Chinese to self-insure, and the only way to self-insure is to postpone consumption through these crazy high savings rates. And in the past, the Chinese government took all those savings and channeled them into these messianic projects like these massive dams and roads and bullet trains and building construction. But now that that's running out of steam and the export engine is also going to start sputtering because of the backlash to Chinese dumping their excess production into the rest of the world, I think we are in a fulcrum. We are in a transition where the Chinese will have no option. They don't like to do this. They hate consumption ideologically because they are communist. They can't stand people just consuming their way to prosperity. And that's why they have the industrial model that they have espoused now for decades. But I think at this point, it's just going to be a matter of survival for the Chinese Communist Party to allow consumers to consume. And the only way they can do this is through all these programs, such as loan subsidies and credit availability and subsidies for different segments of the population. And when that happens, the companies that you mentioned are, you know, told they did. If you think in terms of Alibaba, if you think in terms of JD, Tencent, PDD, they are a toll on Chinese consumption. So, so those are the players we want to look at. Again, opinion, not advice, in terms of booming Chinese consumer over the next 2 decades. And with that, we have our friend Wile E. Coyote, because despite the fact that there are opportunities and we talk about them, we cannot be oblivious to the fact that we are in the Wile E. Coyote market. And why is that? There is no better way than to bring the latest John Hassman update on his great valuation exercise.
Say hi to everyone.
And he's essentially saying that the current level of valuations are the highest in US history. They exceed 1929 and they exceed 2000. So again, we discussed this 2 episodes ago. We thought it was appropriate to bring it back because if you blindly invest in index funds, notably the Standard & Poor's 500 in this case, the total expected return over the next 12 years is a negative 7.5%.
Yeah, we keep beating a dead horse in every episode, but we must do it. I think it's a public service to let people know that on average, assets are extremely expensive. And what we need to do is look at where to fish and only fish in those ponds. And those are value, international small cap, energy, commodities, all the areas that we discuss in these episodes.
That's spot on. And if you think in terms of private markets having a lot of indigestion in terms of private equity companies, private equity owned companies not being able to be sold, funds that essentially are dumped into continuation vehicles. We're not saying that this is a good timing tool because valuation is never a good timing tool in the short term. But in terms of conditional probabilities, what is the expected return at these egregious valuations levels for the general index? Caveat emptor investor in general index funds.
Exactly. And what you mentioned private equity. Now they're going to give us mere mortals the opportunity to buy ETFs with private equity, with access to give us access to private equity. So if that doesn't tell you we are in a danger zone, I don't think you're listening.
Yeah, when Wall Street offers a product that was reserved for qualified investors and institutional investors for decades, that's a sign of desperation. I think 401k fiduciaries, any 401k fiduciary that is truly a fiduciary, shouldn't take that toxic waste into their administered plans. And I think because of that, the adoption of private equity in retirement accounts is going to be very slow and it's going to be very small. The other thing is these private equity offerings are very illiquid. So anytime they put any of those funds into a 401k offering, they'll have to buffer it with 25, 30% of cash. So imagine what that's going to do with returns. So the only way to guarantee liquidity is to put these thing with a lot of cash, and this is going to be overvalued, unsellable assets that are going to come mixed with 25-30% of cash. This is going to be atrocious. So any fiduciary that puts this into their plans, really doesn't deserve any of my respect.
Yeah, agreed.
Now, at the same time, as you mentioned before, we're still seeing this bifurcated market. And on the left-hand side, we have the ratio of valuations between tech and the S&P 500. And this is, again, the most egregious that we have in recorded history, right? Now, at the same time, when we look at valuations or multiple, in this case, the PE multiple, for the equal weighted index, there's still room to run. So it's relatively easy today with ETFs to move your money away from a regular SPY index into just an equal weight index. And by doing that, you're going to be protecting significant returns into the future.
That's right.
Another sign that we are in dangerous seas is this stock overreaction to companies that cut their forward guidance. So this is stock price overreaction when guidance is cut. So in the last earnings season, companies that cut guidance saw their price decline on average 10%. And we posed the question, why is the market so obsessed with growth? And the reason is that when multiples are 22 times forward earnings, they are vulnerable to any tiny decline in growth.
Yeah, I would add a couple comments to that. This last quarter, you saw the big hyperscaler earnings, and they just had after hours, they blew up and had phenomenal increases in price. But what we saw this time was in the following days, we saw these equities come down, and it just kept coming down, which was kind of a divergence from what we've seen before. And I wanted to tell viewers a little bit of history. In the 2000 peak bubble, if you will, we still had GDP of 4%. We still had pretty good earnings. Very, obviously very high PEs, but price started coming down before the economic activity indexes started coming down in 2001. So don't expect the data, the economic data, to tell you when you should run for the hills. Be very, very attentive to price and what the market, Mr. Market, is trying to tell you. In this case, it might be worth heeding his advice.
Yeah, I see this as a crack in the ice. You remember the Ice Age, the beginning?
Yep.
So I think this is the first crack in the ice that I've seen. God forbid we had a mild recession, because people are so dependent on the wealth effect to maintain and sustain consumption in the upper echelons of the wealth distribution, that if we were to have even a mild recession, a mild slowdown in profit growth, that's going to have an amplified effect on markets, and that's going to just, feedback is going to be like a reflexive feedback loop into consumption, which can put us in a very, very bad spot.
Yeah, that's kind of what
another
scares me.
point that the bulls, and I love the bulls. We are bulls, as you know, in many of the sectors and we like to invest. We are bulls in energy, natural gas, in lithium, in the technium. But the bulls on the general market essentially dismiss the concentration as a warning sign. And again, caveat emptor, because every single time in history where we had a bubble, the bubble came accompanied by high concentration. And right now, we're seeing concentration levels that are only similar to the ones we saw in the 1930s during the Great Depression. So you cannot say concentration, then bubble, right? But you can say no bubble, no concentration. So almost you can reverse, and the A then B can be proved by no B then A. So you can say there's never a bubble without concentration. So I'm not saying this is a bubble, but the sign of concentration is also troublesome.
Yeah, that's
and
right.
The concentration is very, very heavy in the Magnificent Seven. So it's Magnificent Seven long is the most crowded trade. So even from a contrarian standpoint, on a technical basis, buyers beware. The ratio of growth to value, again, at a historical high since the 80s. So going back to the theme of the bifurcated market, while the growth stocks are expensive, value has been left behind. So there are opportunities, to your point of where to fish, in value. And one of the areas where hedge funds are very short is still the Russell 2000s. So they're leaving the small caps abandoned, and they have high short ratio levels. In terms of something that you taught me many years ago, in terms of the market liking to create a massive pain to the largest amount of people, the pain trade today, you're watching at it.
That's it.
And every time in history that we had this excess return performance, in this case negative, so deficit return performance for small caps vis-a-vis large caps, that trend had a 7-year reversion. So we have these 7-year cycles that come almost as Swiss clocks. And what we're seeing today is a similar level of excess and in prior cycles. So once again, there are opportunities here. We think, and we're going to be talking about small caps, but we're seeing opportunities in the space that we like and that we like a lot.
That's right. That's right. And this doesn't even capture international small cap, which we're very, very bullish on.
And that's the setup, right? Because you have the underperformance of value, you have the underperformance of small caps, and you have the underperformance of international. So the intersection of the three is one of our themes.
That's right.
This is, once again, another sign of the times. The growth versus defensive growth relative trend, and the relative ratio between healthcare and technology. There is an opportunity in defensive growth, even if you stay within growth, and there is an opportunity within healthcare. Healthcare is very cheap. Healthcare is cheap on the aggregate. There are incredibly bargains within healthcare. And the other thing about healthcare is a beneficiary of many trends, is beneficiary of the booming retiring, is beneficiary of the aging population, is completely insulated from tariffs and all the trade considerations. And on top of that, is left behind.
That's right. I think this is going to be one of the best areas and a great pond to go fishing in.
This is a strong candidate for our 7th theme. And
that's right.
If we look at healthcare as a percentage, the weight of all the healthcare stocks, market weighted, or the total market cap of the index, is at one of the lowest levels, actually the lowest since the 90s. And at the same time, investors are moving money overseas. So going back to the theme, small cap value international, people are awakening to the notion that there are better ponds where to fish, borrowing on the metaphor.
The content of this channel is for informational purposes and entertainment purposes only, and does not constitute financial investment or professional advice. We discuss stocks, market trends, and investment ideas, but these are our opinions and not recommendations to buy, sell, or hold any securities. Investing in stocks and other financial instruments involves significant risk, including the potential loss of capital. Past performance is not indicative of future returns.
And with that, let's talk about a myth that's been making the rounds since Trump took office, which is people trying to find tariff inflation. And Paul and I thought interesting to just run basic math. This is not even math. This is arithmetic, basic arithmetic. So if we think that average tariff rates before Trump or before this administration took office was about 2.5%. And most experts agree and most observers agree that tariffs are going to land between 10 and 12%. Let's say, on a conservative basis, that the incremental tariff rate is going to run about 10%, and that we're talking about a volume on which that incremental tariff rate is going to be applied of about $3 trillion. We're talking about total tariffs collected by customs of about 0.3 trillion, 300 billion. Okay? This is important because this has investment implications. This is not just a curiosity or to add to the political debate. This analysis has important implications, and it has important implications because, as George Soros once said, investing is about discounting the obvious and betting on the unexpected. And people think that tariffs are a big thing. And the reality is that for the overall economy, tariffs are a very small thing. So many participants in the investment game have not yet fully grasped all the implications that tariffs have. So when we think in terms of 300 billion of tariffs collected as a percentage of national GDP, let's say an estimate by the IMF for 2026 in the US economy at 32 trillion, the total tariffs collected as a percent of GDP is 0.9%, so under 1%. But again, the GDP is a value add category, it's a value add notion. It's not a final sales notion. And tariffs and imports are final sales. So we need to compare tariffs collected not with GDP, but with gross output, or even a broader measure of activity. Even if we compare against gross output, we're talking about 0.6%. My estimation is that the total impact on a sales notion basis of all tariffs collected is going to be less than 0.5% of the GDP. So in total, the impact is de minimis. Not only is that de minimis impact, it's a one-time event impact. So there is a lot of discussion, there is a lot of hoopla around the tariffs and its effects on the activity and on pricing, but the reality that simple arithmetic shows is insignificant. The tariffs collected as estimated by US Treasury are exactly the number that we quoted. And when we go back and look at the evidence of what has happened to prices measured via the PCE or the CPI, what we see is that there is no impact of tariffs. We can see that PCE goods is actually growing faster than PCE goods imports. So the trend of imported items subjected to tariffs has a lower inflation performance than the rest of the goods. On the upper right-hand side, we have core goods. Someone might say, oh, let's look at core because PCE goods is impacted by very volatile items such as food and energy. Same trends. When we look at durable goods in the bottom right-hand corner, same trends. PCE durable goods imports are actually inflating at a lower speed than the general price level. If we look in terms of non-durable goods, same trends. What we see for PCE non-durable goods imports is actually a negative price performance. That means these goods are actually experiencing deflation, which is something that should be expected with an economy such as the US applies tariffs. Is there anything, Paul, that calls your attention on all this?
No, to me, it makes a lot of sense. And however, it's counterintuitive to the narrative that everybody's been pushing in the media. I always thought that you might get an initial small bump, but then because of the elastic nature of demand for most of these products, you'd get substitution, and you'd normally end up actually either with lower prices or the same price as before the tariff. That was my intuition.
That's right. And again, someone may say, oh, you picked the PCE, the same dynamic you have if you look at the CPI, same trajectory. And then the skeptic might think, oh, but you're taking a very short time frame, and the reality is that goods have been deflating, especially imported goods, for a longer time period. True. But when you look at what happened since January 2025 or even before, that trend of declining prices of imported goods remains unabated. And why is this important? It's important because from an investing framework standpoint, most commentators and participants don't yet grasp what's going on. If you have an imported market, as you have depicted in the chart up top, what you have is an international price that is represented by PW on the left. That horizontal line at PW is the international price. The only way that you have imports in that market is because at those prices, demand exceeds supply. So you have an excess demand over domestic supply that is filled with imports. The exporting country has exactly the dual situation. They have the same PW price crosses the demand and the supply at a level in which supply exceeds demands. And that's how some countries become importers and some countries become exporters. Now, what happens when an economy such as the US economy imposes a tariff? So we are at PW level. At that price, we're seeing imports at the level between supply and demand. But when the tariff is applied in the US, it creates a gap. In the right-hand chart, you have the demand before the tariff and that downward shift of the demand curve when the tariff is applied, because for each price, there is now a gap between what the consumer in the US pays and what the exporter receives. And that essentially drives down the international price. So when the demand curve shifts downward to the left, the P colon W is lower, which is essentially a transfer of welfare from the external supplier or the foreign country to the domestic country, to the importer country. And that's what we're seeing. We're seeing a decline in the imported prices. And it's funny to see all these journalists struggle with the notion is, but if we're collecting $300 billion in tariffs, who is paying the tariff? Well, the reality is that the tariff, a big portion of the tariff, is already absorbed in the new price that exporters charge after the tariff was imposed. So there is a shift in the demand. And the funny thing is that the more inelastic the foreign supply is, so the more vertical the XS curve is, And the more elastic, the more horizontal the MD curve is, the more of the tariff effect is borne by the foreign supplier. And what's the situation that the US has? Because it's such a large economy, a Chinese exporter, most likely than not, doesn't have an alternative market where to ship the goods that are shipped to the US. So the supply is very inelastic. But from the perspective of the US consumer, the demand is very elastic because we have many alternatives with which we can substitute. So it's very likely that a significant portion of the tariff is absorbed by the exporter. This is not voodoo economics. This is 101 economics.
Yes.
This is something that economists have known for decades. So I'm still perplexed at the fact that this sort of technical knowledge hasn't filtered through the common knowledge, and people are still struggling to understand that the foreign price is not a fixed entity. It's a very, very soft entity. And when an economy such as the largest consumption market in the world, applies a tariff, it's no surprise that that creates a deflationary effect on export prices for all the suppliers into the US market. So in sum, in any metric that we want to look at on the left-hand chart, the PCE goods, the PCE goods imports, the PCE core goods, the PCE core goods imports, the CPI goods, the CPI goods imports, in none of those metrics we're seeing effects of inflationary tariffs. Not only we're not seeing inflation from tariffs, we're seeing deflation in export prices, which is exactly what the theory predicts. And it's a perfectly valid assumption that in reality, most of the tariff is being borne by the foreign producer. In addition to that, I wanted to share with you that even though it's true that for a small economy, the optimal tariff is zero, because a small economy cannot influence international prices, for an economy as large as the US, it's far from truth that the optimal tariff from a welfare standpoint is zero. In fact, there is this curve that grows up to an optimal level, and then if we exceed tariffs more than an optimal level, we start to see declines in welfare. But it's very likely that what the US is doing right now, even though it's not good for China, or it's not good for Europe, or it's not good for Vietnam, is very good for the average US citizen. And to my shock, after we had prepared this presentation, I came across this piece in Barron's by an author named Julia Graf. Is the first piece in which we find someone in the economic, financial, journalistic community who understands that tariffs are not going to be inflationary. Number one, as we saw,
got it.
They finally got it. So number one, but this is going to be one. I'm waiting for CNBC to have at least one journalist to admit that this is not the case. They continue repeating and trying to find inflation in tariffs. They're not going to find inflation in tariffs. So the first thing is, on the aggregate, overall tariffs collected on a volume of dollars collected are less than 0.5% of any relevant metric of economic activity. That's number one. Number two, when a large country applies a tariff, that tariff is borne by the foreign supplier in a big proportion. And number three, a tariff is not inflation, because inflation is the sustained, continued, cumulative increase in prices, and a tariff cannot create that. If you never read Milton Friedman, maybe you're forgiven to not understand this, but you cannot have inflation due to a tax. The only way inflation is going to persist is if you have a central bank who is increasing the monetary supply to drive demand. But a supply shock as a tariff cannot be inflationary. So when I hear someone talk about inflation and tariff in the same sentence, it only tells me it's a very ill-informed, uneducated individual. So hopefully people like Julia are going to start becoming more and more the mainstream and are going to start explaining to their audiences how is that tariff cannot be inflationary. And maybe even we get lucky and someone is going to explain that the economic community and the academic literature for a long time has known that for a large economy, zero tariff is far from optimal. And now let's go to some of the investment implications of tariffs. And Paul and I were on the phone when we heard that tariffs were coming for autos. There was a big discussion around this. Do you remember our conversation?
Oh, yeah.
So it was communicated that a 25% tariff that it ended up being 12.5% was going to be applied. And then we did a simple math. Let's take the GM P&L. And if we go and look at the GM P&L, the gross margin is about 12.5%. So if you have a P&L with gross margin of 12.5% and you apply a 12.5 price increase, and that 12.5 price increase can be because the tariff is 12.5%, and as we saw, that increases the domestic price by 12.5%, or it can be because you apply a tariff of 25% and the foreign exporter takes 10% discount just to absorb part of the tariff as we saw. So if that's the case, and assuming that 50% of your cost base is of imported components that are subject to the same tariff, which is not the case, but even assuming that case, the per unit profit that GM is going to have is 50% higher after the tariff. And there you have the math. Now, the situation is probably much better for GM. Why? Because most of the components and parts that GM uses are manufactured in either Canada or Mexico. And as long as those components satisfy the rule of origin of the USMCA, which the majority of those components do, those components continue entering the US market at 0%. So we're talking about profit margins at the gross margin level, which is just flows through the P&L like a rock to the bottom line, going from 12.5% to 18.75%. So 50 higher absolute profit per car on a 12.5 tariff. Paul, how do we reconcile this with this price performance on the left on the stock price of GM?
Well, we were flabbergasted because I remember we bought, I bought shares of GM after the close on Liberation Day, and I was shocked when I saw the price going down, because it just, to us, it doesn't make any sense. But I think people started getting it.
People are getting it. Now, we concluded that 12.5%, in the worst case scenario, assuming all components go up 12.5%, which is not the case. So they have plenty of money left over to pay higher wages and expand capacity, etc. But assuming that worst case scenario, we're talking about 50% higher. The question is that all for the domestic producer? And the answer is no. The answer is the end game is much better. Why? Because some of the tariff is going to be passed on to consumers. Indeed, let's assume that is a small portion, 12.5% out of 25. If that's were to be the final tariff, then the domestic production is going to increase. So not only they're going to be making more money per unit at the status quo, they're going to be selling more units. They're going to be gaining share because the total market is going to shrink, imports are going to contract, but because remember, this is a market where at prevailing prices, there is a deficit of domestic supply to total demand. That's satisfied by imports. So the higher price is entirely satisfied by more production of the national domestic OEMs. So the profit margins for GM are probably going to triple. And that's what people, to your point, are starting to are starting to understand. In the right-hand chart, what we see is that since that decline through today, the price went up 24%. But that is putting the price barely where it was before Liberation Day.
Yeah,
So that
there's
means
a lot more to go.
a lot more to go. Bingo. So it's important because, once again, when you make these distinctions, when you have this variant perception, and by the way, we're not recommending GM. We think there are way better ways to play the tariff non-understanding by the market. But when you have a variant perception, you can capitalize that variant perception via smart, intelligent value investing. And clearly, there are many opportunities being created by this lack of understanding as to how tariffs work, because for most investors over the lifetimes, this has never been an issue. This has never been something they had to grapple with. And the reason they have not ever understood the implications leaves people like us with opportunities to allocate capital in a smart way.
Yeah, and now we show people the math, and hopefully people sort of understand and wake up to the facts that a GM will have greater share of the market because there was that deficit to begin with in domestic supply, and it will actually have bigger profits, and that should turn into a higher stock price, and people will start understanding that. I love the the work that you did on the slide showing showing exactly where it comes from. I think it was very educational, and I think it'll be very good for people to see exactly where our thesis comes from.
Yeah. And the elephant in the room is not only that tariffs are necessary to reshore critical supply chains for national security after what transpired during the pandemic, but also because those tariffs are necessary to start closing the budget gap that the US has. So it has also a fiscal implication. As we saw, part of the tariff is paid by China and by Taiwan and by the foreign suppliers. It's a way to collect taxes without taxing taxpayers in the US, households and companies. And that ties to the main focus of our discussion today, which is along the lines of the age of fiscal dominance and yield curve control. And this is our theme number 3 around fiscal dominance. We have two legs, the one associated with precious metals and the one associated with the housing boom. Today, we're going to focus on the first. This chart is setting up the stage for what we call the age of fiscal dominance. And this is another one of those situations in which we need to change the mental models and the framework under which we operate. Because while historically sort of the traditional Keynesian Mandel Fleming IS model worked, this is a model that is obsolete for these times. This is a time in which, in contrast to what we saw in the last 40 years or thereabouts, the total debt as a percent of GDP is north of 100%. And not only is north of 100%, we're touching 120%. And we're touching 120%, and this is going to continue to increase because we're seeing deficits at 6.5% of GDP. That means that we need to add to the pile of debt another 6-7% every year. This is during good times. This is when inflation and unemployment is at 3%. With unemployment at 3.5%, 4%, we are now at 4.2%. The fiscal deficit is 6.5% of GDP. if we were to have a recession, in the typical recession, those deficits balloon 300, 400 bips. So we could be talking about 10, 11% deficits over GDP that would add to the debt. And what's the implication of these levels of debt is what we see at the bottom. What we see at the bottom is that we are now paying 1.2 trillion every year to just serve the interest on that debt. So we are paying an amount of interest that is similar to our total defense budget at 1.12 trillion. So if we have ballooning debts, continued deficits, and high interest rates, this very quickly, very soon becomes an untenable, explosive situation.
That's right. Janet Yellen was the person that normalized these sort of near 7% GDP deficits. And she also made the mistake of having probably the lowest interest rates in 5,000 years and basically financing the debt on a short-term basis through 3-month T-bills. So she gets sort of the Dunn's prize for finance, as far as I'm concerned. But yes, you look at the interest rates currently, which are around 4%, and you have that 1.2 trillion that we need to finance, and we keep adding at a rate of 6.5%, in a time when we're still growing the economy, and you say to yourself, where is this going to end up? And where you and I believe this has to end up is in suppressing interest rates. So fiscal dominance is a period where you're going to continue to have fiscal spending through the Treasury, probably even if a recession ensues in the next year or so. Like you said, the percentage of GDP will be higher, but how do you finance that without blowing up the economy and putting it into a depression? There's only one way to do that, and that is using yield curve control and all these operations like Operation Twist, et cetera, that we saw in the 2008 financial crisis, in order to basically suppress yields so that people can afford to run businesses, can afford to buy homes, and keep the economy running.
And this is the key conceptual distinction of these times. When you are in a setup such as the one we just described, the typical tools of monetary policy work differently than they used to work. In the past, monetary policy can do its things of moderating the business cycle when there is an economy that's running a bit hot, increase rates, that's going to, hit consumption, and it's going to hit credit, and it's going to hit housing because it's more expensive to borrow, and all those activities are very sensitive to borrowing costs, and therefore you have a control in the demand side, and that tames activity a bit, reduces inflation, and the opposite when you're running through a soft patch. The problem is that when you are in fiscal dominance, you completely lost that instrument because the only thing that matters is to fund the government. Funded. If the government cannot be funded, then there's nothing left. You cannot pay the army, you cannot pay Social Security, you cannot pay Medicare or Medicaid. And we're not saying that we're close to a situation. What we're saying is that the first order of business is to fund the government. And when you increase rates to try to temper the economy, if the economy is running a bit hot or inflation is a little bit above the target that the Fed theoretically has, then what the increase interest rate does, it doesn't stop demand. It actually fuels demand because it's the government paying more interest to the private sector. And in the process, it bankrupts the government. So you completely lost the ability to use monetary policy to moderate business cycles. When you try to fight inflation, you are bankrupting the government. And that's the reason why the administration has been so vocal and so aggressive against a stubborn, ridiculous stance that Jay Powell and the rest of the FOMC is having. You completely relinquished the ability to run monetary policy after you allowed this ratio of debt to GDP to balloon to 1.2 and your interest expense to balloon to 1.2 trillion and exceed the entirety of the defense budget.
Right. And to put it in short, the Federal Reserve is impotent. It no longer has an ability to do anything. The only thing, its job from now on is buying the debt that the government issues, because the alternatives are creating a Great Depression.
Yeah, my kids, my two sons who play video games would call the Fed now an NPC.
What's an NPC?
The Fed became a non-playable character. You see in the games that you are like the actor, and then there are all those who are like fluff that they move around but they do nothing.
Yep.
So that's what the Fed became. The Fed became an NPC, and the Jay Powell, the chairman, and the board of governors are pretending that they are actors, that they are playing. The two mandates are gone until the debt is again under control. So the law says that the Fed has a dual mandate, which is full employment and price stability. All those mandates come after the first mandate. The first mandate is you need to fund the government. If the government cannot pay its bills, there's nothing left. So this stubbornness that they are showing is to me an indication that they are in denial of the situation. And this is a chart that you call my attention to in one of the Bannister. And what we have here is whether tax revenues can even cover the unavoidable expenditures. And what are the unavoidable expenditures? You need to service the debt because the U.S. is not going to default. It will be the end of the financial world. The U.S. needs to pay mandatory spending such as Social Security, Medicare, and Medicaid, and pay the bills for veterans and Veterans Affairs. And we need to pay defense spending. So in 2025, we're on track to the point where the combined expenditures on interest entitlements and defense are approximately 120% of all federal tax receipts, we excluding all other discretionary spending.
So we've got,
and this is a number that has recent.
Right. So we look at this as a business. The U.S. government is a business, and we've got a shortfall of 20% that we need to plug. So how do we do it? We need to effectively borrow more money. And that money has to be borrowed from the public or the Federal Reserve, right?
Yes. Which is going to make the interest component go into an unsustainable position because, as we saw, we're running 7% deficits. Interest rates are not even that high from a historical standpoint. So God forbid we enter a recession or we had a bad auction, it becomes a crisis immediately, and you're going to be seeing the Fed doing QE by another name. They're going to call it, Jay Powell came into Trump 0.1 or whatever to the new program they're going to launch, but they are going to be forced to buy treasuries, right? And the other thing I wanted you and I discuss is Powell. So Powell became a Fed governor in 2012. And in the time frame in which he has been governor, the balance sheet of the Federal Reserve ballooned from 3 to 9 trillion, right? So it was him and his peers at the Fed, and mostly him, because if you look at the purple on the right, it was when he was chairman,
Yes.
that the balance sheet ballooned to 9 trillion from 4 trillion. So it was him who enabled the fiscal side of the equation to commit all these excesses over the last 5, 10, 12 years. And now that he created this untenable situation, he's the obstacle for that situation to be resolved.
Yes.
Right?
You can't have gotten us pregnant with octuplets and then at the end say, okay, sing the virtues of abstinence. It's just ridiculous.
It is. And so what's going to happen? We're not saying this is a good state of affairs. We're not saying who's right, who's wrong. We're just describing
how we manage it
almost arithmetically what's going on, what's going to happen, and then as investors, how we position ourselves to something that is just obvious. So we can argue whether it's going to happen in the next year or in the next 2 years, but this is unavoidable. And the administration, the good news is that many people in the administration are keenly aware of what needs to be done to get out of the situation. And many of the recent legislative acts fit into this framework. The Genius Act, the Stablecoin Act are all steps in the direction of increasing demand for treasuries. During the Second World War, it was the war bonds. So people were incented to buy war bonds out of patriotism. Now we're incented to buy bonds out of stable coins or Ethereum or cryptocurrency. And this is going to continue and become larger because the government needs to fund itself and we need to reduce interest rates. And the more demand it is for these bonds, clearly the yield goes down and therefore the interest expense for the government also goes down. So there you have all the litany of measures that we expect are going to happen. You mentioned Operation Twist. That's coming to a theater near you in force. We are going to see short-term rates coming down. They need to come down with or without Powell. And we know who's going to win this battle. You mentioned yield curve control. These are all mechanisms to just put pressure on the yield curve to reduce the cost of interest to the government. And this is what we call financial repression.
That's right.
There's going to be the SLR, which the SLR is the supplementary leverage requirement that the government imposes to banks, and essentially is how much capital they need to reserve for holdings of treasuries, and this is going to be relaxed so banks can make more room for treasuries in their balance sheets. There's going to be more quantitative easing, as we mentioned, the stable coins. There's going to be money market reforms. There's going to be probably intrusion into pension allocations. We're going to be seeing everything that the government can do for the private sector to hold more bonds.
Now, let me ask you a question. What does this make people feel about the Federal Reserve? Does it make them trust them or distrust them?
Yeah. So I think going back to this, they actually lost the ability to remain independent. People keep talking about the Fed being independent, which is a way of saying monetary policy is independent from fiscal policy. The problem is that it completely lost that ability by enabling the balance sheet to skyrocket to 9 trillion and enable all that debt on the other side of the ledger, which is the debt that the government has. Because monetary policy cannot be independent on fiscal policy when the government cannot fund itself. If the government cannot pay the military, if the government cannot pay the civil servants, if the government cannot fund Medicare and Medicaid, if the government cannot fund rural hospitals and people start dying, there's no monetary policy.
Right.
So the problem is that they lost themselves by allowing this. So now it's too late. They can pretend that they're independent, but they lost that war. And they didn't have the guts to say no in 2018 or 2020. Well, 2020, let's say, it was the COVID crisis, right? You can give them a pass, but they continue expanding way beyond and enabling the government to expand way beyond its means throughout all the Janet Yellen tenure, way after the emergency of the COVID pandemic was over. So right now we're in this situation, and they don't have any more independence. They are only going to regain independence when debt to GDP goes back down to 65-70% of GDP.
Now, I would say that people now have less trust in the Federal Reserve. People now are looking for alternatives to what is claims on the U.S. government, which are, let's say, dollar bills or $100 bills or whatever. They don't know if that is going to be worth anything. And we've been talking about the need for inflation to probably get up to 7-10% in order to inflate the debt away. So people, for me, what is levered most to distrust of the Federal Reserve is gold. I think it's in general hard assets, but then you think about, well, I don't know, a building is a hard asset, but you can't cross a border with it. You can with a kilo of gold. So these are times when people start looking at putting their money in hard assets, and hard assets that are very fungible and easy to transport. And that's why you have gold and silver, and recently platinum and palladium have been rallying considerably. So yes,
those things that are somewhat independent of the whims of monetary policy are the assets that have been responding very well to the state of affairs.
That's right. So in this slide, we talk about all the asset classes that are candidates for accumulation in what is, to us, an increasingly difficult situation for a Federal Reserve, specifically in this fiscal dominance, where the only role the Federal Reserve is going to have is buying the government issued debt, and that's it.
Yeah,
they're going to have to forget about inflation.
We can fire all the PhDs, which we don't need. Frankly, are pretty useless in the Fed, and all the bureaucrats. I mean, we can send Doge, and we can leave just Christopher Waller and Bauman for the supervisory role. And the rest is, guys, we just need to fund the government and just stop pretending that you are independent, because you touched on the key implication of all this conversation that we just had. And the key implication is that we need to run negative real interest rates until debt becomes manageable. And that means that, pick your number. Where do you want the Fed rates, Fed funds, and the yield curve to be? Like 2.5%? Perfect. We need 3% negative. We need 3% negative real rates. Okay, so inflation needs to run 5.5%, 6% for 10 years. Right. And that's the goal of the Federal Reserve. So the goal of the Federal Reserve, until debt becomes manageable again, the same way was the goal in the aftermath of the Second World War, is to target negative real rates at 3.5%.
Right. And
instead of all the nonsense about price stability and full employment, right, which eventually at some point is going to be recovered, but not until the government is free to pay its debt. So going back to your point, because real rates are going to be negative, whether Powell likes it or not, or Goolsbee, who is a political hack, likes it or not, those rates are going to be negative. And the assets that thrive in that environment are exactly the ones that you listed.
Right. And if people take nothing away from this episode, please take away this, subscribers. Start measuring everything you do in real terms. Measure every investment. If you're going to just put money in money market funds or whatever, think about the real rate that you're going to get on your investment.
That's great advice. I mean, nominal is worthless. The only thing that's going to matter is whether your investment preserves the purchasing power of the money you're putting into the investments. Because in nominal terms, it's going to be very easy to have high returns. The question is, are those high returns enough to keep up with inflation at 6.5%, 7%?
Bingo. That's it. That's why I feel it's so important that our viewers really take that home and think about it and measure any
Exactly.
future investment through that lens.
Now, you and I don't invest in gold. We like gold, but we don't buy gold because there are better ways. In fiscal dominance, as you said, gold emerges as a great hedge against inflation and financial repression. We've seen gold just in 2025 go from 3,300 an ounce to 4,500 an ounce, and it's going higher. And the beauty of gold is that it's a hedge, but the downside is that you need to store it, you need to safeguard it, you need to pay carrying costs, and there are ways of doing that in a leveraged way and in a way that someone else pays for all those costs for you, right?
Yep. At one point in my life, I was a futures and options dealer in the London Bullion Market Association, and there is such a thing as allocated gold and non-allocated pool gold. The latter, which is what normally everybody trades, and what it is pieces of paper that give you title to gold in the vault, but it could be any gold. And a lot of times it could be, a lot of these papers are floating around and they're a claim on the same gold. So you have multiple
you don't
claims
want
on the same
everyone
gold.
to claim their gold at the same time because you have a gold run.
Right. What people do in order to safeguard from that is they buy allocated pool gold, which is, you have your piece of paper with the serial number of the bar, but that costs a lot more. And frankly, you and I don't want an asset that we have to buy and store and pay all those costs for. What we prefer is something that has a leverage component to that price, and that is gold miners.
That's it. That's where we wanted to land.
That's right. And I spent part of my career in two gold miners. So I do know the business fairly well. And it's been a great business over the last 10 years, with the exception of a few years when the market got a little crazy, people took on a lot of debt, and the industry became hated because people didn't deliver on what they had promised. But here, for example, we look at this quilt, and if you look at the upper part from 72 to 79, I think we're probably going into a period that is very similar. And if you look at those returns on gold, they're spectacular. And if you put in a certain amount of leverage, through a mining company where a mining company right now could be mining gold at, let's call it $1,300 with all the
Mm-hmm.
costs in operating cost and maintenance capex. They're just minting money.
Yep.
Here in this slide, you can see, for example, the column that says AISC, which is all-in sustaining cost. You see some of our favorite names, which are Endeavor, Equinox, Eldorado, and Fortuna. Their costs are, other than Equinox, you have costs that vary between 1,300 and 1,700. These are pretty reasonable costs to produce gold when you consider that you're probably making twice that by selling the metal. And some of these companies are trading at price to cash flow of, in some case, single digits. In another one of my favorites, which is Alamos Gold. There's a company that's not on here, which is Agnico Eagle. For me, it's always been the reference standard for production and management. That company, by probably the first quarter or first half of next year, will have paid off all its debt.
Mm-hmm.
And they're doing buybacks and paying dividends.
Yeah, they need to get their operational back together, and there's going to be a rocket ship.
Yes, exactly. And there's another company that's
Opinion, not advice.
yes, opinion, not not advice. There's the ones that you see in the block here are trading very cheaply, in part because Endeavor, Fortuna, Eldorado have operations in Africa, which they get penalized a little bit for on geographic risk.
Mm-hmm.
But there's, for example, a smaller cap company called Wisdom Gold, which is trading at 5 times next year's cash. Probably an all-in sustaining cost of $1,300. So if you think, if you look at charts for these stocks, you're gonna see sort of prices going almost vertical. But I think there's a much bigger gain for these companies because they've been maligned since the 2011 sort of debacle, when they really sort of overpromised and underdelivered. So I think we're just starting to get back to miners being very disciplined, very cost conscious, and starting to deliver on their promises. I like the sector. I think it provides very good returns long term. Now, there's also another thing that I wanted to mention. A lot of these companies are starting to pay off all their debt. And at the same time, we have the junior miners, which are GDXJ for gold and SILJ for silver. And at some point, the good projects are going to get purchased by the majors, especially if they keep making so much cash flow, paying off their debt and needing to increase their pipeline. So these ETFs with the juniors might be also a good way to get an extra alpha.
Yeah, the pushback on that, and I agree, by the way, but it's important to understand the risks.
Yeah.
And And the pushback is that the industry is being notoriously for its shareholder destroying M&A, right? So
Yes.
hopefully the majors and the consolidators are going to be smarter this time, but the reality is that it's an industry that's been very undisciplined in the way it's allocated capital. And that's why now I think we can get it on the cheap. Is
Yeah.
because they lost so much money for shareholders for so long, misallocating capital, that now essentially it's like the boy who cried wolf. People don't yet believe that they are finally going to be making money.
Yeah, and you're right. And a good example of a good transaction that I just saw was Equinox Gold buying um,
Calibre mining.
Calibre Mining. Calibre Mining is an outstanding operation, low
You don't have
cost.
to tell me.
I know you owned it, and I think you probably took the Equinox shares. But
Yeah, I'm
it's
a
been a
shareholder now.
yeah, it's been a very good transaction. I know the guys at Equinox, and I'm pleased to see them do that transaction. I thought it was intelligent.
Yeah, that's a great asset. So if we were to recap, we need to get the trend right. That's the first thing. The trend is we are in fiscal dominance. We're going to be seeing financial repression, YCC, and negative interest rates. The Fed mandate is going to be fund the government and target a negative real interest rates, so we don't bankrupt the federal government. In those scenarios, we don't need to be creative or to have incredible foresight or to be prophetic. We have episodes in history where this already happens. One of those episodes is in the aftermath of the Second World War. The other episode was in the 70s. As Paul was mentioning, 1972 is going to be 2026. And in those periods, what we have is gold and commodities thrive. Now, gold, for all its beauty and its shine, has its drawbacks. We see a better way to play gold that is through the gold miners. Why? Because, as we just discussed, they have an AISC, an all-in sustaining cost that is, let's call it $1,500. And let's be very pessimistic. Let's assume that the gold price is 3,500. That means, right, that you're making $2,000 an ounce. So you don't have to be a genius. My son, like my 6-year-old daughter, can go on the column of T&T reserves for Equinox and multiply million ounces, right? I know $2,000 an ounce and compare that to the enterprise value minus debt and decide whether this is a cheap or expensive asset. And the reality is that many of these things on that basis, on that metric, look incredibly cheap. Now, this doesn't stop there. If the gold price continues rising, which is our expectation, because we are in a stagflation scenario such as this quilt between 1972 and 1979, with 1972, in my view, being 2026. And on top of that, you have all the upside that potential we're going to have in the short term if oil prices remain low, because the ratio of gold price to oil is the ratio of revenue or cost for the miners. You know this better than I. And that's essentially mean that many of these miners have upside over what they are forecasting here in terms of total cash cost and in terms of AISCs.
Yeah, that's right. That's a good point. The gold to oil ratio has always been seen as a proxy for operating margins, and that continues to be at a very good level. And um, given our views on crude, it is going to continue for a while. And things like you know metals that you need in mines for balls for ball mills and things like that. A lot of this steel, um, you know, obviously comes from iron ore, and we see that iron ore is an oversupplied market, which has very little good price action at the moment. So I think costs are going to be maintained at levels that are pretty good for these valuations, and gold is going to continue to go up because it is a hard asset that that is very applicable to the scenario that we're looking at.
Yeah. There is another way. If you want to play this theme, you can play through an ETF. You can buy GDX, or you can buy the Sprots Gold Miner. We don't have any affiliation with those companies, so this is just for the sake of completeness and thoroughness. If you don't want to buy an individual stock because you don't want to take the idiosyncratic risk, many of these companies operate in very dangerous jurisdictions, and you clearly have a jurisdictional risk. It's not the same to extract gold in Canada or the US than is in Congo or in some other place where the government and the rule of law it's not the best. So you can buy an ETF and have a diversified portfolio of gold miners, and that allows you to play the trends and to play the macro view without excessively concentrating on any idiosyncratic risk.
Absolutely.
One of the things that we're seeing is that this is already starting to happen. And this is the quilt fast forward a few decades from the one we just saw. And 24 and 25 have been among the best years in gold. And gold has an amazing track record, especially after, we confiscated the Russian assets and most central banks started converting their treasury into gold reserves. But we think this is just the beginning, and this is a trend that we're going to ride for the next 5 to 10 years, and it's going to be a very good way to protect our assets in the age of fiscal dominance.
Excellent.
Wow, that was a fantastic discussion. I always learn something chatting with you, my friend. It's just such a joy to do this together. I'm having a blast.
Absolutely. It was a wonderful show today. I have to say, please, if you liked it, hit the subscribe button, and so that you'll keep joining us on future episodes. Next episode will be interesting because we're going to continue on this hard asset theme, but now discussing real estate and a market that's been very controversial because people are calling for multi-year highs, and we see things a little bit differently. So it'll be a lot of fun.
I look forward to it.
Fantastic.
Over and out.
Okay. Take care.
Take care, my friend.
Bye-bye.